I'm Oliver Turner, the Executive Vice President of Corporate Development for Karora Resources. Karora Resources is a Western Australian growing gold producer. We have 3 assets in Western Australia in the Kalgoorlie region, the Beta Hunt mine, the Higginsville mines, and the Spargos Gold Mine. We also have 2 mills, and we're currently expanding production from about 100,000 ounces a couple of years ago, all the way up to close to 200,000 ounces by the end of 2024.
Oliver, good to see you again, and you're in Perth.
Yes, I am. Yes,
down there, so seeing the team. How's it going down there?
Really good. Yeah, no, it's good to be back in the the operational office and the day-to-day stuff that people are working on right here. We just reported our results last night, Perth time. Obviously, in the morning in Toronto, Eastern Standard Time. A lot of work went into that with our board meetings and a lot of operational updates. So it's great to be here in the thick of things. We're also going to be hosting an analyst tour for our research coverage analysts next week, which we're super excited about. Get to show them the assets, take them around, and show them all the cool things we're working on.
Cool. Okay. Well, look, I quite like talking to producers because you can produce. You're producing gold. We don't need to have a conversation about can you produce gold. You're doing it. What I can do is look at some of the numbers. Okay. So obviously you're going to sort of throw out some of the big numbers in terms of record revenue, just sub $100 million bucks, and actually you're reporting a net earnings figure as well. So obviously things are going well on the ground operation in terms of the gold production and gold sales. But you've got so many moving parts to this thing. Sometimes it can be hard for people to kind of follow what's going on. So why don't you give us the big headline numbers, and then I want to talk to you about growth plans, because I think that's the bit that excites investors.
Yeah, absolutely. So obviously just reported fourth quarter and 2022 numbers last night, as I mentioned. 2022 was a record year for Karora. We're growing year after year after year, both when it comes to ounces that we're producing, as well as cash flow from operations, which is ultimately what matters in the end, and that going straight to the bottom line, all while growing and reinvesting into the business. So last year, our guided range was 120 to 135,000 ounces. We produced just under 135,000 ounces, right at the top end of that range. And for those of your investors who've been following this story for a while now, we had a challenging start to the year last year, not of our own doing, but of course in the first quarter, second quarter, early last year, here in Western Australia, it opened up for the first time in 600 plus days, which of course brought COVID-19 through, which impacted operations. So it was a challenging first half of the year. We still delivered on our ounces, but there's those cost impacts. Second half of the year was phenomenal, and that brought us right back into those guided ranges. So as I said, just under 135,000 ounces, and then on the cost front, we reported all-in sustaining costs of $1,171 or $1,171 per ounce, again within our guided range of $1,100 to $1,200 an ounce. So a really strong performance in the second half of the year is what reined in the impact of that that COVID-19 reopening early on in the year. That went right through to the bottom line. We reported really strong adjusted earnings and EBITDA numbers, which, obviously allowed us to continue to grow. In the end, what matters most is cash, right? We exited 2021 with $90 million in cash, and we exited 2022 with just under $70 million in cash, whilst continuing to develop the underground decline at Beta Hunt, whilst purchasing the Lakewood Mill, while reinvesting into our properties. So what we said a couple of years ago is still ringing true here. This has been a self-funded growth plan the whole way while we generate cash and continue to expand the operations.
It is, but all businesses need to make money, right? So we need some idea from you as to where the money is going, when it's going to come, and what it's going to be used for, and how do we benefit, right? So At the moment, there's obviously no dividends being paid out now. You're plowing the money back on the ground, and therein lies the danger with producers. They're making money, they're making revenue, and they're putting it straight back in the ground. So come back to my question around growth plan. Are you setting yourself up for success in the future, or are we going to see more of the same behavior where you're buying mills and you're spending money as quickly as you're making it?
Yeah, so we've obviously laid out the 3-year plan, which we originally put out in 2021. We ended up solving one of our biggest risk factors with the purchase of the Lakewood Mill versus expanding the Higginsville Mill last year, which was tremendous success, and has actually helped us to improve our production even faster than we had originally planned, which is great. But when it comes to the growth plan, so the key factors, obviously, now that we've got that Lakewood Mill in place, is basically all focused around Beta Hunt. So it's the addition of the second decline at Beta Hunt is of critical importance. We were really happy to report about 4 weeks ago that we actually completed that second decline ahead of schedule. And that's because we started it from two directions. We actually started from underground and from surface at the same time, and they met in the middle. We finished it ahead of schedule and on budget, which of course in this cost environment is a great place to be. So that second decline, the access was completed. We're in the process of adding in ventilation. So that's added in over the course of this year. And then the capital injection into the decline is finished. What comes next? So currently we produce, around about 100,000 ounces out of Beta Hunt. So a little bit more than that this year, actually. How do we get there? We mine 3 to 4 stopes a quarter. I'm not going to dive too much into the technical details here, but those are massive stopes. This is a very large earth moving operation. We are averaging over 110,000 tons a month out of that ramp, which is just huge. And whenever you visit the site, you see the size of these 60-ton trucks underground. It's just an incredible operation to witness. So we're doing about 100,000 ounces or just over that from that single decline right now. The second decline will add additional capacity, brings total mining capacity from 1 million tons per annum up to 2 million tons per annum. But to get there, you also need more stopes. So over the course of 2024, we'll be developing those additional stopes, and we'll exit 2024 at that run rate of 2 million tons per annum. So come 2025, your capital deployment into Beta Hunt is complete from a growth perspective, and you're generating incredible amounts of free cash flow from the 160 to 170,000 ounces that you'll be mining out of Beta Hunt alone. Obviously, there's still Higginsville, and just under that 200,000 ounce a year mark from the corporate perspective.
Right, but okay, so Beta Hunt looks like you're setting it up for success, but the money that's going to come from that, is that going to be plowed back into Higginsville, Spargos? You've also got this nickel play, which I want to talk about in a second.
Sure.
Do you know what I mean? It just feels like you're creating money to plow back in the ground. So again, if you can give me some sort of inspiration as to what's there to look forward to.
Yeah, 100%. I mean, obviously we work in a finite resource business, right? So number one, you have to find more of that resource. You have to find more ounces. In order to do that, you have to put money into exploration. Here's a pretty incredible number for your audience. So since 2019, we've grown our resource at Beta Hunt from about 400,000 ounces all the way up to 2.4 million ounces. We've done that via the drill bit from existing underground development. Our discovery cost is about $15 an ounce. The conversion cost is about $20 an ounce. For $35 an ounce, you're finding and bringing an ounce into resource that you can then mine. That is extremely efficient use of capital. The ROI on those dollars spent is absolutely phenomenal. Not only do you turn that into cash in the near term, but of course you get a valuation multiple based on the life of mine that you extend by adding more ounces. So you got to grow the operation. You have to find more gold to mine. In order for us to generate more cash flow and more free cash flow, you have to invest in that expansion. Once we're at that run rate at Beta Hunt, the 2 million tons per annum run rate, we might even be a little bit higher than that, but let us get to 2 million tons per annum first. Once we're at that run rate, it's about harvesting cash. It's about continuing to grow that resource and continue to add ounces, but harvesting that free cash flow. And then as a business, of course, you mentioned it earlier, there's things like dividends that we can talk about. There's things like share buybacks, when it comes to dips in the whole sector that affect everybody that we can look at, and other ways of returning cash to shareholders. But as a gold mining business, as a mining business in general, you always need to be investing in your future, because if you don't, that future comes up on you very, very quickly. And we're seeing it in the sector, across with a lot of other names that are running right through their reserves and resources. Without that reinvestment, you'll never have it. But we will always, always, always focus on strong cash flow generation and eventually, of course, return of that capital to shareholders.
Okay, right. So reserves, resources increasing, good news. So let's look at some of the deployment, some of the other capital. Let's start with exploration first, and we'll get on to nickel. So what are you doing at the moment?
Yeah, so last year, obviously, we just announced, again, about a month ago now, I think it was February 13th, we announced increased resources and reserves. We had a tremendous amount of growth in our resource base, over 500,000 ounces, and that's in just 8 months since the prior update. I mean, Beta Hunt is the mine that keeps on giving when it comes to adding gold ounces. It's a phenomenal place to be. Our focus this year is going to be on two things. We'll always continue to expand our resources. So our goal every year is we mine ounces, and then we add, obviously, our depletion back plus some. If you look at the last 4 years at Beta Hunt, we've actually, as I said, gone from 400,000 ounces to 2.4, but we've mined 400,000 ounces over that period. So we've actually found 2.8, which is pretty cool. So we'll continue to add resources. We're also going to convert those resources into reserves. That requires obviously inferred resources into M&I resources, which then turns into reserves. So that's very important. With respect to targets, where are we focusing? So everybody remembers Larkin. We talked about that for about 2 years now. From initial discovery through to resource was 18 months. Yep, that's pretty good time frame, and we're already generating cash flow out of that region, which is pretty cool. When it comes to new targets, Mason is very, very exciting. It's parallel to the Larkin. It's starting to look like a Larkin look-alike. It is something that we're going to focus on this year. And we're going to focus on bringing into resource in our next resource update, which comes out at the end of this year. So the Mason's fantastic. We've also got Cowsill, Fletcher, Sorensen, all of these shear zones at Beta Hunt that we keep uncovering. We're going to focus on those over the course of this year. So you'll get some more drilling results, probably here in the next month or so as we batch these things up and release them. But Mason is looking very, very interesting.
So why have you refreshed the 2023 and 2024 production guidance?
Yeah, for sure. So it's a good point. So let's take a step back here and we won't reminisce too much, but that guidance has only basically been put out once before. It was put out on June 28th of 2021. If we all think back to the world that we lived in 2021, zero cost money was basically flowing around. The world was a wonderful place. Tech companies were trading at 35 times forward revenue multiples. It was a wonderful world that we lived in, right? And seemingly there's no end to this money, and the cost environment is very, very good. Fast forward 2 years to the environment that we've all been through over the last period of time. Everybody, the concept of inflation is not going to be any stranger to any of your investors. We've seen that when it comes to almost every input cost that a mining company or any company can have. When it comes to consumables, so we talk about reagents, we're talking about input things like diesel. When it comes to labor, all of these things have seen upward price pressures. So what we did was we basically updated it to the current cost environment that we currently exist in today, our previous forecast. And we've done a couple things with it. So let's start with the gold ounces, and then I'm going to step down to some of the costs and give you a few more details there. When it comes to the gold ounces, we've tightened up those ranges, but the one that's probably the most important is 2024. That's the furthest out one that we have right now. We took about 5% off the top end of gold guidance. 5% is not that big of a deal. We went from 205,000 ounces at the top end to 195,000 ounces at the top end. Why did that happen? Well, it happened for a very good business reason. So originally we had planned to start up the Spargos underground mine. We finished the open pit mine in mid-2023. It's going to be a good mine. It's going to continue to generate revenue. A little plug here. We acquired Spargos for $4.5 million. We've mined over 40,000 ounces out of it. It's been a really, really good piece of business for Karora shareholders. We're going to be going underground there as well. There's some phenomenal grades there. However, late last year, as we started to crystallize some of those economics around the nickel opportunity, here's another number for you. I know we're going to talk about nickel in a second here. We'll get to some more details, but there's over $1 billion worth of nickel sitting there in Beta Hunt in resource, ready to be mined. When we started to run the numbers on those, we realized that in terms of ROI on our capital deployment, look, we are a growing gold company. We're a junior that's growing into probably a small sort of mid-tier, let's call it an intermediate. We have limited capital that's available to us in terms of cash flow from operations without going out and raising more money. So if we spend $1 here, sometimes we can't spend $1 here. What we did was we took $1 away from that early startup of Spargos Underground, and we're putting it into accelerating that nickel. We realized that the ROI on those dollars is much, much higher. So we decided we'd expand the nickel a little bit faster, push Spargos back by 1 year. It'll start at the midpoint of 2024. And on gold ounces, the impact was a little bit of a trim in 2024 on the top end, about 10,000 ounces. We'll get those ounces in 2025. They're still coming. They're not going anywhere. They're still in the ground. So that was the decision on the gold ounces. Coming down to all-in sustaining costs, you've obviously seen a bump up in all-in sustaining costs. That is obviously a reflection of the reality of the current cost environment that every single mining company in the world is experiencing right now. It's not just Western Australia. It's not just gold mining companies. It's certainly not just Karora. It is every mining company on earth. I am not going to name any kind of names, but we're seeing average AISCs across a lot of the sector in our weight class that are well north of $1,500 US per ounce. So margins have certainly been shrinking with these cost pressures. So we updated there, but we have one ace up our sleeve. And I keep talking about what we're going to talk about because I'm really excited about it. And that is the nickel. And that is our decision. That is our it's our insurance policy, or our way to insulate ourselves from any further cost increases, is bringing that nickel on as fast as we can. because the byproduct potential there is tremendous.
Okay, so explain how that works, because you made a decision in the backdrop of a rising gold price. Okay, it's been a good few weeks, but it has only been a few weeks. But there has been this massive disconnect between gold equities and the commodity price of gold. Do you see that changing? And if you do you not see that changing better than, say, perhaps the nickel price? Because again, nickel price has had a good run at the beginning of last year and sort of come off a little bit. So why are you doing that arbitrage between we'll go for the nickel now rather than focus on the gold?
Yeah, so a couple good points there for sure. So we've obviously seen gold prices come up for sure. When you look at the reality of input cost pressures across the sector, input cost pressures have increased at a faster clip than gold prices increase. So when you actually look at your margins versus 2 years ago on gold ounces for every company in the sector, for the most part, margins have actually shrunk. Now, what we're starting to see, which is great and good news, early days yet, hopefully these signals are right, is we're starting to see a plateau in those input cost pressures. And in some cases, not labor, but in some cases, you're actually starting to see them come down a little bit. If gold price takes that next leg up, and we can talk about that in a few minutes if you like, and sort of thesis on where gold could go, that's pure margin expansion. That's fantastic. Nickel, on the other hand, at Beta Hunt, and this isn't a gold versus nickel decision. This is a gold versus a nickel decision in Beta Hunt. We can access nickel by turning left instead of right. The upfront capital cost to bring on that nickel PA that we talked about last year was under $10 million. The IRRs that drove, or the internal rate of return that drove, were well north of 230%. It is an unbelievably high return project. Our margins on the nickel are about $15,000 a ton. It is a very, very profitable business for us on a per ton basis. We are a gold company. We will always be a gold company. We're going to focus on gold. If we left that nickel and pushed it back by a couple of years, the amount of cash that could generate for our shareholders, leaving that behind wouldn't make much sense whatsoever. You will see the benefit of that start to flow through to the byproduct credit line, which will lower your all-in sustaining costs as we ramp up that nickel. It is absolutely tremendous what we can do with that. So it's a very high return project within our existing mine that we can access very, very easily. That's the difference. If we had another nickel project, for example, that was outside of Beta Hunt, we would not be making the same decision. There are no big ramp up costs for this. This isn't a decision on a metal. This is a decision on how do we make the most money the fastest today.
Okay, well, music to shareholders' ears, I'm sure, if you deliver on that. So just sticking with that.
Just before you say that, I mean, we do have a track record of delivering quarter after quarter after quarter.
You do.
Your shareholders should probably believe that we're going to deliver on this.
You do. Good point. Well made. But that's my line. I usually say that about you. Okay, so no, absolutely. But with regards to the nickel and how much you're allocating to it, remind me how much you've chosen to spend on the nickel component and why that number versus something 50% higher, 50% lower.
Yeah, so I mean, let's sort of bring it back to the one rate limiting step or bottleneck that exists in the whole operation. Let's talk about that. It's ventilation, right? We've put that additional decline in. Done. Great. Fantastic. You cannot bring more equipment or more people underground until you have more air, right? We've got a fully running operation right now doing just over 1 million tons per annum. We did 1.1 million tons per annum last year, which is fantastic. We need more ventilation. So 1 of 3 vent raises, done. Second one, underway. Third one comes later this year. Once that ventilation is into the mine, we can bring in more equipment, which is both trucks for the gold, drills to drill off everywhere, and personnel. Once that's in, we can then fully execute on those capital deployments. So we can't just decide to spend more money today and bring it forward really, really fast. We are limited by that ventilation. That's why you've seen the 2024 number go up slightly, because we want to accelerate that as much as we possibly can in 2 different ways. We're going to be obviously working on developing those nickel faces to bring on the nickel operation. We're also going to be drilling like a bat out of hell on that nickel side of things. I mentioned it earlier, but I think it's worth reiterating. Our current resource, the updated one that we just put out a few weeks ago, is 34,500 nickel tons at Beta Hunt. Okay, so that's contained metal in the rock. In 35 years of nickel mining at Beta Hunt, all your viewers, I think, know by this point that it historically was a nickel operation for 35 years before it became a gold mine. In 35 years, 66,000 nickel tons were mined. We have just over half of what was historically mined in 35 years in resource drilled out today. Pick your nickel price. Conservatively, that's worth over $1 billion. Our market cap is $800 million right now. It's worth over $1 billion of nickel there today. Every bit of extension that we do that's to that nickel resource, as it adds an incredible amount of value in situ. And what we want to do is we want to accelerate as many phases to ramp up nickel as fast as we can. We put a PEA out on what we think we could do initially. And I'm not giving any kind of new guidance here, but I'm saying I think that we might be able to beat that once we get there. We're going to be doing about 2,000 nickel tons per year. Those are some pretty serious numbers when it comes to byproduct credits. So we will be expanding more. That's why 2024, you saw that growth capital number creep up a little bit, more of that going into nickel. That's why you've seen a little bit of shift in ounces versus nickel tons. We're putting more of a focus on the nickel tons in that interim period. Why? Simply put, you generate more cash. That's what everybody cares about.
Right. Okay. And with regards to what generally happens in markets like this is producers go off and buy other producers and spend a vast sum of money doing so at the height of the market. The markets are a little bit wonky at the moment. Gold price is high. Do you expect to see a bit more consolidation in the market? And are you going to be part of that?
Yeah, I mean, you just take a look at the side, see some of the deals that were happening, right? We're in a really unique period right now where valuations have come back to very much back to earth. The gold equities, there's a huge decoupling from gold bullion prices versus the valuations that gold equities trade at. And what we've seen is a lot of producers, obviously, very large reserve tables that they need to replenish. In the last couple of years, it's been a producer for producer purchase. Everybody's been focused on immediate cash flow generation. And as we all know, there's only so many of them out in the world there that you'd actually want to acquire that are decent, where you have real synergies. We're starting to see a little bit of a move, B2Gold Sabina deal, for example, from the producer space down into the large developer space because they need to replenish, their future production profile as well. But it's definitely been a bit of a shift. On the same time, and this isn't the case, it was a reminder, I spent 7 years talking to institutional investors as a research analyst before this on a daily basis. At the same time, you have institutional support for M&A. That's not always there. So we're in a deal on environment right now for the right deals. Now let's talk about what matters to the largest investors on earth, okay? We'll take a little bit of a step back here and then we'll come back to the M&A point because it's very, very relevant. Generalist investors who manage most of the world's active money, much, much larger, and this isn't not an insult to the gold space or gold investors, I'm one of them. The gold sector is a tiny, tiny, tiny little sector compared to other sectors. Now, therein lies the opportunity. When the generalists want to get into the sector, there's only so many homes they can find, and you want to be one of those top homes on their list. How do you become more relevant to generalist investors? You get bigger. You get bigger in terms of production profile, but most importantly, in terms of market cap. They don't want to go all the way down the list. They want to pick the top 5 names in a weight class. So from an M&A perspective, there's a real narrative here that doing the right deal at the right valuation, where 1 + 1 does equal 3, to get bigger and generate more cash puts you further up on the radar screen of these generalist investors that we all always want to attract. And all you need is a very small allocation of their portfolio. We're talking single basis points of their portfolio. If that flows into this sector, we're off to the races in terms of equity return.
I've got a great line here on that. Just helps people kind of picture it in their head. If you took all of the mining companies from BHP, Rio down to the smallest explorer prospector, bundle them into one company, it would be 50% of the size of Apple.
Yep.
One technology company. So when you were talking about deployment of capital for some of these big funds, we really are a minuscule sector, and just a very small portion of what they could deploy into this space would make a dramatic change. So I hear what you're saying, for sure. Can we just talk about a little bit more about gold and what happens next for gold? Because our thesis in the background is I think that producers are really, really important, because I think that it's suffered perhaps in the past of being something that people would look at and go, well, they're fully formed now. There's no leverage. There's no real upside to these things. And when people are talking down in the exploration space about 10 baggers and 20 baggers, it doesn't have the producers don't have the same sex and sizzle there. But coming back to my theme for this thing, which is growth story. What's happening next for gold? What's happening next for gold producers?
Yeah, no, so it's a great point, right? And if you're trying to attract those larger investors, and even for people that are gold sector specialists, where do they want to put their money, right? There's two major types of investors. You got value investing, you got growth investing. Now, I would argue that the majority of the gold sector right now is already a value play, just where equities are basically sitting. Now, on the growth side of the equation, if you want cash flow growth, self-funded growth, money generating growth, then you basically want to look at stories that are expanding at the same time as obviously they're trading at attractive valuations. A lot of the producers right now are sitting in that snack bracket, and Karora is certainly one of them. Look, we are 18 months away, less than 18 months away from basically hitting that peak rate. We're expanding right now, but at the same time we're doing it, we're generating cash. At the same time we're doing it, we're expanding gold resources. We're putting a lot of money into exploration, which is benefiting all of our shareholders from an NAV perspective. So that's something that's really, really interesting. And I think it also helps to de-risk your investment on the downside, right? If you have an expanding cash generating gold producer, you don't have an entity that's potentially running out of cash, or you don't have an entity that lives and dies on the drill bit. So it's kind of the sweet spot right now for gold investing is those cash flow positive growing gold producers that are funding their expansion from basically cash from operations. That's where you want to be. Layer on another consideration, and this is a core factor, not for everyone. We're in probably what I would consider the best mining jurisdiction in the world when it comes to permitting new operations, when it comes to you don't need to deal with any political instability, you don't need to deal with regime changes. So by buying a stock like Karora, parking it, looking at it 12 months later, and I would encourage everyone to do that with any gold investment because we live in a volatile sector, things can go up and down very quickly in a day. By doing that, you're buying a limited downside story with incredible upside and torque to a potential gold rising price environment, which I think is the best place to be in the sector.
Well, I agree with you. I'm sort of intrigued by the timing around that torque, that spring coil, as it were, that gold feels like again. And what that's going to do for producers, then I think eventually some of the better, more advanced development companies. So interesting times indeed. A few other things I just want to just very quickly, because people kind of forget about all the kind of the hard work stuff in the background around things like the ESG report you put out, the carbon neutrality, hitting that again. And as and then also you continuing to just tinker with the balance sheet in terms of credit agreements and so on. So this kind of operational focus is great because it's building the potential scale for this thing, which is I think we're in violent agreement with that is so important going forward. But also sort of building the company up the right way so that these institutions do rank you for the right things. You're spending a lot of time on that one, building nice teams up there.
Yeah, like it's to use a bit of a phrase as a Canadian. We talk about skating to where the puck is going, not where it is right now, right? So that's something we decided to do a couple of years ago when it came to what are the biggest limitations, whether they agree with it or not, on large fund managers in this day and age, right? We're seeing more and more mandates coming down from their LPs and their investors that have requirements that are ESG linked or carbon linked. So we decided to get ahead of that. And to be honest, I've said this on your platform several times before, it's led to several very large institutions which have built very large positions in the stock and allowed existing institutions to increase the size of their positions. So that's been very, very successful for us. And on the ESG report side of things, actually, we've been nominated for that inaugural report, which is actually pretty cool and not bad for our first one ever. So that's been really, really important. On the debt side of things, we made the decision to replace our previous debt facility, which carried a 10% coupon rate on it, at just the right time. Now, the strategy was right. Timing is fortuitous, but we'll take fortuitous timing at any point in time for sure. We locked in a much lower cost of capital on that Macquarie facility than we previously had. So what does that result in? Less interest payments going out on an annual basis, which is ultimately what it costs. Less of a drain on our cash balance. We also got the validation of the largest Australian investment bank and a global player doing, very, very strict due diligence on our process and validating that for us. Now, why does that matter? It matters from all sorts of reasons when it comes to raising, additional credit or any kind of M&A that you want to do. It's a huge validation. There's a lot of investors too that realize that debt service providers do a level of due diligence that's far greater than most others. So that was a good stamp of approval for us. We're extremely happy to do that. When it comes to moving forward, like what's next? What are these other sort of side projects that we're working on? Something I kind of want to draw attention to, and it'll continue to make more sense as we get through over time. We are a nickel supplier to Nickel West. So Nickel West is BHP's concentrator. It's a whopping 4 kilometers away. So we'll never have to build a nickel concentrator. We haven't had to do it before, but previously we were trucking about 400 kilometers north of Beta Hunt for a nickel. Now we're doing 4 kilometers. They restarted it. BHP has an agreement with Tesla. Tesla builds batteries. Tesla does life cycle assessments on the batteries. They want to build green batteries. In order to build green batteries, you need green nickel. In order to have green nickel, you got to be able to supply green nickel. What does Karora produce? Green nickel. So that's part of our strategy as well, is thinking ahead to what are the suppliers and purchasers of nickel going to want, and that's why we've moved ahead there. There's several other projects, and I can't talk about them yet on your platform. I'm hoping I will be able to in the next couple months here that we're working on that tackle 2 things, both absolute cost reductions, but also emissions reductions. And remember, there's always a cost in carbon that'll help, basically improve our bottom line as well. So a lot of these things go hand in hand. A lot of investors view these as mutually exclusive. It's absolutely not the right way to approach it. There's a lot of things that can benefit cost lines at the same time as addressing some of these other issues that attract additional investment. And it's been good for us so far. We've got a great shareholder roster because of it. And we've been recognized across the industry for being leaders in the space. And that's what we like to be, leaders.